Welcome to the Twomey Stock Market Report. This is James Twomey, and today is Saturday, August 6, 2022. Well, a lot has transpired. What an eventful Friday, and we now have a clearer picture on what is going to develop, and certainly short term and well into the fall. So let's start with the news flash. Recession update. We did get the confirmation 2 quarters negative GDP, bonds inverted, rates rising. All the technical indicators and economists follow and watch to determine that, yes, we are in an economic recession. Next shoe to drop. We've mentioned this before. If there's a major decrease in hiring or layoffs, be on alert for that number. If layoffs start to exasperate, it's going to hurt the economy even further and cause us to go into a deeper, prolonged recession. Manufacturing index, if it gets below 50, that's a contraction of manufacturing production, and that also means less goods are being built and serviced out the door, and hence they don't need as many people, they don't need to buy as many materials, etc. It becomes a spiraling effect. However, what happened Friday? Friday, we got the jobs report. It was outstanding. Yes, it was. We added more than expected. Unemployment ticked to 3.5%. Just a phenomenal reading in such a dismal inflationary spiraling last several months. This is very good sign. Whether it's lagging or not, the bottom line is if people are retaining jobs, if companies maintain some type of hiring pace, and what happens? Well, people can afford the higher prices. So therefore, with a job, yes, you're going to buy less, but you can still afford that pricing to some extent, right? You could pull in here, pull in there, and then, buy what you need to buy at a particular time. They already said that school supplies are starting to be at higher levels than expected. Hence, they're seeing a less demand for some of the products. This is how it happens. However, if we still have a job, or most people have a job, this recession will be more mild. And we have a better chance of what they call a soft landing, which really is a difficult task. It most likely impossible task. So what does this all mean? Well, the central bank now has a little bit of time on its side, but they do not have the luxury of slowing hikes. This just exasperates that. They're going to have to continue their hikes. The 0.75 rate increase for September is now up around 60%. They were looking at 0.5. So it's a situation that really policymakers really hope to avoid because we're not anywhere near the 2% level we want to be. Even with gas prices coming down and a few other items coming down, the gas is a big thing because I think I paid $4.09. I did $4.09 today. Big difference. I was down to Cape last week. It was $4.59 to $4.69. So, certain areas have better rates. But all that said, it's going to help on the producer, and the consumer price index to some extent. If it levels off, that's great, but we're still at 8-9%, inflation. Even if it goes to 7%, I mean, that's high inflation, and it's going to cause huge impact. Translation, it puts wage pressure on companies. People are going to be able to skip out of their job, go to another job for a few bucks more, and that causes wage inflation. Wage inflation affects the bottom line of companies. If they can pass it on to the consumer, terrific. If they can't, they have to find how to balance that bottom line a little bit differently, and sometimes that's layoffs, right? So more to come, but it's certainly we've got a little bit of reprieve here, and the market is starting to show that. Other items. Liz Ann Saunders, Chief Investment Strategist at Charles Schwab, she said, may start to hear the chatter of intermediate hikes, but only if the next batch of inflation reports really hot. It may be high, but I don't think, I personally, I thought they should have did interrate hikes, intermeeting hikes uh, earlier in the year, and they could have gone smaller amounts, but it would be a much more impactful event. But there's something that's hidden in here. We talked about this. Was the Fed really going through QT? What's QT? Quantitative tightening. Instead of buying bonds and stocks, which they had been all through the COVID and prior to that, and they've been doing it for many, many years. Maybe next section we'll go over the actual trillions that they have, but they're talking about 8, 9 years of potentially running it off just to get to like 50% down. But with that said, 47.5 billion was the goal to get rid of in the last 2 months. They accomplished 31.2 billion in 2 months. So the Fed really roughly only reduced their goal by 22%. So they're not really running off the balance sheet as quickly as they wanted. Now, albeit it was a target, but it wasn't something that was cast in stone. However, this does tell us that during the summer we saw the market going up and propping up, and we were like, hey, is the Fed really rolling back? Because while they're raising rates and reducing the balance sheet, those are two things that should cause tightening of money supply, right? Less money makes less availability. It drives rates of borrowing money higher, etc. So the balance sheet reduction supposedly is going to be picking up steam. That's what Chairman Powell said in July 27 meeting. They roughly 95 billion monthly increase in tightening is supposed to start in September. That's doubling of the balance sheet reduction plus the highest fund rates since 2018. Raising rates, that is, could mark a moment of extreme stress on markets. It did 4 years ago when QT ramped up. Eventually had to abandon that. So we really haven't seen the full impact of what the Fed was said to be doing is reducing the balance sheet. Once we do with the hikes, it should really tighten money supply. I also read somewhere they actually bought $3 billion in bonds last month, but so be it. They weren't supposed to buy any. So all that said, what that's going to do, the record volatility is going to. You should expect record volatility as liquidity drains at rates never seen before, right? So from August through the end of the year, expect some volatility. Bond yields dropping. We said this before. Money is flowing into the U.S. from overseas. It's helping the Fed sell bonds at lower rates. The yields are inverting. It's all kinds of problems going on with the bond market. But at this point, they're able to get rid of bonds at a fairly low rate, not increasing the deficit. We all expected that the yields would have had an increase. We expected TBT and TBF to continue its rise as it was the last 6 months. It has abated. We did go to the TLT, and more on that in our stock trading because we're starting to see that volatility we talked about. As far as we talked about gas and oil, Energy Information Administration is showing that gas demand dropped 9.25 million barrels per day to 8.5 million barrels per day last week. So that's a pretty good reduction, and it's solely based on demand. So if demand is retreating, that's going to help lower pricing, right? And less demand, more to go, and people will compete to get that dollar. In addition to that, the 1 million barrels being released by the strategic reserve pile, it's a drop in the bucket, but it's help abating it, but because that's every day. The Saudis are saying they're going to add some more to the supply. Not a heck of a lot. I think 100,000 barrels. But with all that said and done, really it's the demand. So if gasoline demand remains low, crude prices may not spike, and the pump prices may continue to fall. I heard that it could get down to like 370 to 390 on an average. The target is to get back to 220, like pre-election and pre-COVID, but that's really the baseline, and we're nowhere near that. even if it goes to 370. So other things, government bills and spending, CHIP, and the inflation greenie package, I call it. Well, okay, also the infrastructure package. Infrastructure package, it's great. It's going to help give two things. It's going to create jobs in that sector, and we're going to improve bridges, roads, airports, what have you, transportation areas. That's a good thing, but it's not. It stimulates, yes, because short term it creates these jobs and it improves. It's kind of like shovel ready jobs. Kind of helps if there's low unemployment. I mean, high unemployment and people need jobs. That's, stimulus, and it kind of puts people to work and gets them off the unemployment sector. We don't have that. So now it's going to cause more wage inflation because everybody's going to compete for these jobs. Number two, on this type of bill, once it goes away, it's gone, right? It's a flash in the pan kind of stimulus. If you increase your budget and you cause companies to really foot the bill to meet that demand of purchasing by the government, that often leads to new company growth and innovations, and companies have to foot the bill themselves, and they have to be profitable, and they have to do it without what I call the welfare. If you start just handing out money and expect people to, produce, it can often become what I call a boondoggle somewhere. We certainly saw that under Obama administration when he tried to do some solar panel stuff, and it went into a sinkhole, and the company actually went bankrupt. The inflation, the chip package, that's going to be some good things. We missed probably the run up, but we want to get in that play. It's going to take 5 years before a chip is produced, but it's probably a good thing to do. And that, if it's handled correctly, and companies are innovating and expanding on their own dime, that's good. But if it's a handout, just like the infrastructure package, it becomes money that just sloshes around, and it doesn't become efficient. So more to come on that. The inflation package is not an inflation package. It keeps saying reduce, drugs and some healthcare. Hey, I'm all for that. But all this other stimulus for green initiatives, again, it goes into money sloshing around versus making companies be productive so that they can compete and compete and participate in increased government budgets. So handing out money versus buying stuff is really the equation here. It's a short-term shot in the arm. It's also going to cause inflation to stay up there. It's going to cause wage, inflation. It's going to cause, this, competing for workers. So translation, like I've said this before, inflation doesn't start overnight. It doesn't go away overnight. And if this sticks around for a long time, the Fed's going to have a hard time beating the drum to get that inflation rate down. The only arsenal that they have is raise rates. Are we going to be up 7, 8, 9% on rates? I'm not in the prediction business, but 2.75 is not going to do it, right? So we've got all that underway. We got all our buy signals. We're going to go over those. We talked about how the dollar may be, leveling out and impacting. Matter of fact, the dollar was par with euro. Now it's 1.1 to 1, so it's costing you 10 cents more to get a euro. So with that said, where are we? Stocks. We're long the indices by, the Dow, NASDAQ, SPY, small cap. We're using, except for NASDAQ, we're using Schwab's funds. So we're going to dive right into that right now. And let's take a look at the first one. SCHX, or the diamonds, right? Basically, we got our buy signal here. We succumbed and finally jumped in last week, a week ago Friday, Thursday and Friday. So we have 1, 2, 3, 4, 5, 6. And we've gotten a little bit of a bump. But as you can tell, this is important. We're above the 50-day, right? We've got a nice spread between our 14 and 9 EMA, and we're definitely cross positive. Our buy signal is back here. We're starting to get up against near the 200 EMA. So let's talk about support. On the way down, we've got support at the first the 9 EMA, then the 14 EMA, and then the 50, right? So we've got quite a bit of gap to get back down to the 50. Number two, we're running into this supply chain here. 1, 2, 3, 4, 5, 6, 7 days are pretty much going sideways. And what happened last time we went sideways? We got a reduction of buying and we started seeing selling. So we have to determine over the next few days where our sellers evaporating or our buyers evaporating. And that's going to be developing over the next few days. It looks like with some of our other economic and fundamentals that we're reading out there and the good job growth that we probably are going to go sideways or up the rest of August. Now, what are we going to bump into? This is the Dow, if you will, using Schwab's ETF SCHX. This is the daily chart. We're bumping up to the 200 EMA. So the goal here is to get to the 200 EMA technically, and then can we go and reach above that. And lastly, the relative strength index was as high as 65, and we are now abating a little bit. We're down at 64.6. Not great. We're still nearing the oversold, but it's something that we want to be aware of. Diamonds is that was the proxy for the diamonds, and let's take it. Sure enough, the diamonds is doing the exact same thing as we expect. So we're with the Schwab. What are we going to do there with the Schwab fund? We've got our first third right below the 9 EMA stop. So our first stop is going to be, in this case, 48.3, 48.2. The next third is down at the 14 EMA, 47.89 is that. So you'd want to put your stop at 47.8 or 47.7. And then we hold the last third for the crossover. Since we got in late on the cross up because our bias took over, we may have to make some decisions on that last third. So that's the other thing was interesting, and we're going to go to the NASDAQ next. The NASDAQ had a nice run that, again, we got the buy signal. We didn't partake, but it's had a nice bump. And this is, we're talking about resistance level now. The RSI, we were up at 68.75. That is definitely oversold in my book. 70 and above is usually the indicator. It's come back a little bit, but it's still at 65.7. It's also bumping up against its 200 EMA. It's been very rough this whole year, this 200 EMA line, really this whole year. As you can look back, it's been resistance. We had a little peekaboo above it at some, at a rebound attempt, and then we came crashing down. So that we have to be very cautious. One, will the 200 EMA act as resistance? Or if we go above it, there's a good chance we're going to rise above to that last high, which would be nice. We'd be up around the 365 range. So let's go to the XLK. So these are all good things. Our MACD is strong. Our stochastic still strong. Our indication is to be in the market and holding our longs. All right, so the XLK, reason why I did the Qs first, XLK is a technical ETF for technical stock, mimics the NASDAQ to some extent. It's got some other technology weighting versus the pure NASDAQ. But with that said, we are above, and the 200 EMA is acting as resistance, even with that downdraft on Friday. So this is a good sign. If this continues, at this RSI is 67.6, and it either goes sideways or starts to expand, good sign. So we're long there, and then we may want to be adding if it drops, on lower days. We did surpass this sideways move we were talking about. That's another good sign, and more resistance. So the NASDAQ actually looks the strongest right now, and it was the weakest. So you want to be long there, and you want to be adding on as it drops, and as long as it stays above the 9 and definitely above, in and around the 200, it's worth adding. SPY, then we use that in the same scenario as the Dow. It's bumping up against the 200 EMA. We've had a little bit of reduction on the relative strength index, but it's still around 65, very high. Well within our Twomey trend track line. My guess is on this one, we're going to, again, try to break above that 200. We're fighting this sideways moves just like in the Dow. So we're long there. Our stops are accordingly on the 9 and 14 and the third for the inflection point. If we go to SCHB, do I have it up here? No. SCHB. Yes, SCHB. Okay, so let's do that. SCHB is our Schwab proxy for the SPY, same as the Dow proxy. So the Schwab is telling us the same thing. And our stops, use our stop principles: a third right below the 9, a third right at or below the 14, and hold on the third. And this, if it's we can add a little bit as long as it stays a little bit above the 9 EMA. So we're at that because we did get that cutback, but it worked out on Friday, but it rebounded nicely. So we're gonna see. You have to be careful. Our stocks, we did get in right after the buy signal for U.S. Steel. We've been adding. Anytime it kind of opens up low, this does move like a point a day sometimes. So if you are going to add, see if you can get it at a point from the latest high below. So if it's in this case it had a high of 2407. And then it had a low of 2208. So that's, a little over 1 something. So depending on, that high, you want to get it, you're looking at, can I get in at somewhere, again at 22.9 or 23 or something of that nature to add to my position. But this is same thing, bumping up against the 200 EMA. So we got to be cautious. We are protecting our profits at this point, so your third at the 9 and the third at the 14 is important. And this certainly has the chance, if we can get by this, the buyers and sellers in this area here, right? I don't know if you can see my mouse right there, and it can get above the 200, is a good probability. There was not a lot of buyers, but there was sellers. So on that way down, it could be a nice ride up to this next inflection point, which would be about 30. Tall order, but it's certainly one we're looking at. What else did we have in our stock buys? XLU, some of you got in that earlier. XLU has certainly been running for a while. It's still the case. This one, we had the buy signal way back here on the 25th of July, excuse me. And it is, we've had a nice parabolic ride. We'll see where this ends up. Most likely, we're probably, 73 is our first stop on the first third. This, again, all predicated on this sideways, move. We're in this, resistance area. And right here, right there. And what's our relative strength? All the charts are saying the same thing. We're up at 67.5 relative strength index. We're having the stochastics coming down. They're all saying, hey, we're at a point where we're either going to exhaust or go up, right? If the exhaust and then pulls back, the selling can be fierce and hot. But there's not a lot of bad news out there. the only thing that we're going to hear from now on throughout the rest of August is going to be, hey, how can we maintain this inflation? We got the, CPI coming out next week. So, more to come. But basically, this is the part of trading. That's why we have our stops. If we have a flash pullback, we're going to, get that 2/3 pulled out. We're going to maintain. I always say we're not going to buy at the bottom and we're not going to sell at the top. But we're going to play that game in between those inflection points. And we're going to go in strong and hard. We're going to make our profits there. We certainly, this is the second run on XL View. Depending on when you got in, not a bad ride. The other is our dividend play, PAA. That's a commodity. It's an American pipeline from the producer to the user, if you will. It's U.S. and Canada. This is a very interesting one. Short story, if you look at the weekly, it tells the tale. It is a sideways for the last, since, you got some highs and lows, but basically, if you look at it, even if you go to 9.5 to highs of near 12, it's averaging somewhere in the middle around 10 and a half, right? So this one had an 11% dividend. I don't think it's there anymore. PAA is down to 7.6, and that's because it's rising quite a bit stock-wise, right? But either way, it had an 11%. Not too shabby. Anyways, 9-10 is not too shabby either. So basically what I'm saying is if it drops a point, 10%, you're going to get your dividend to cover you, and it's a great way to park your money. And now we're enjoying a nice ride up. So every time it comes down around 10 and a half, I add a little bit, figuring that's our midpoint, and I can adjust my stops accordingly. So that is certainly one that we want to take a look at, and take a look at it, continually adding, right? Relative strength index on that one, 62. So again, everybody's running up against, this one's got, multiple resistance, 9, 14, 50, and 200. You can see Friday we had a huge price swing, and we had a big downdraft earlier at the end of last week. So a lot of movement, a lot of play. Actually, there's a stock that TRP is another pipeline that just made a deal. The Canadian company made a deal with the Mexico with getting a pipeline started to get the direct access of shipping gas and oil. There's no buy signal here, but that would be something that you may want to take a look at. And if you want to, take a small position, you just be careful and make your stops tight. What else do we have? We're back into CPG. We did U.S. Steel, right? U.S. Steel, yes, we did. CPG, that one is interesting. It bounced. We definitely are seeing our inflection point. It's nearing a sell signal, and we may have to get out because we don't want to watch it go down from our sell signal. So I'm going to put that in orange or yellow to alert us, even though we had the buy signal. The only reason I'm again a little bit biased here, but I want to see how this 200-point maintains, and it's in the Twomey trend track line. So we're going to make a decision in the next few days. If we do decide to get out, we'll let you know. CPG. Oh, Blink. So based on the potential, and it looks like it's going to go now, the the Inflation Reduction Package, which is basically translation, is going to be a greenie package. Blink, the charging stations, that certainly took off. It's up against the 200, and then if it takes off from here, we're going back up to highs, no doubt. The relative strength index 69. So we're all in the same boat on every stock. Caution, 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 use your stocks. TAN, I say get in on a pullback. That's the solar panel ETF, which is doing very well. Again, news on that. So I had a low buy and actually got in last week at 80.8 average. So, basically you look at this gap. If it holds the gap, 79, I use 0.7, I use the 80. 0.1, I want, a little bit higher. If it closes that gap, it's going to 77.4. So I say, okay, if I can get in at 80, my stop's at 75. There's a little bit of risk, but this should continue to bounce around and then eventually, hopefully, go further. So we're in that. What else? Okay, so we're talked about, we did take a mouse hunt. What's a mouse hunt? Mouse on GDX, gold miners. Gold did, kind of pull back, so it's going sideways now. GDX is the gold miners picked that over gold. Gold actually was doing better than the miners, and typically when gold starts to improve, the gold miners race off for even higher first. Did not see that. We're getting near an inflection point for the 9 to cross above the 14. We're not quite there yet. If it happens, we're going to add, dramatically to this gold. Gold is risky, just like all our commodity plays in oil, so it's risk. The mouse hunt, when we get to 120, go ahead, we buy, and then based off of that, we say, we're going to take a small position. We're hoping that hoping is a great technology term, right? That the daily is going to go and cross above, and then we're going to go all in. But so it's a premature act, but we try to judge it accordingly. And then, what's the 120-minute chart? It breaks up it's 2 hours. It takes every trading day, and it charts a bar every 2 hours during the trading day. So I get a smaller picture, and it tells me if with some buying, does it result in further selling, lower lows, or does it maintain higher highs? It gives me a little bit of a snapshot. You can see how the selling came, but it kept going to higher highs. We had a couple inflection points here, wrote it out. And with that said, if it continues and we get the positive crossover, we'll go all in. But right now, nothing's really, it's moving sideways. We haven't got that signal yet. Mouse hunt, why do I call it that? We go after big game, and often we end up with a mouse head versus the big moose head. So to mount on our wall. But, we got our stops in. Our stops are pretty tight here. I would if you're in it, you want to, get your stop in, around 25, 25.2, and your risk is, a point or so. All right. Let's see. What else do we have? Bond ETFs. Wow. Okay. Why did we go into bonds? We wanted to park our money during this run up, and we thought, hey, if the economy kind of falters or the stock market has volatility, what we've seen is with the employment numbers maintaining high, even though we're in recessionary technically, the yields have not increased. And since yields aren't increasing and a lot of money's flowing into the U.S. from overseas, we wanted to take advantage of it. So we bought into the TLT. We got our buy signal. We jumped in. We wrote it up. It's a very slow mover. And what has happened? Friday, we got our first third and second third stopped out. So we're holding the third for the inflection down. Now the question becomes, we've got a relative strength index of 49.5, kind of in the middle. The question becomes, are we going to continue with yield staying flat, and will TLT rebound? There's quite a bit of volume selling. There is, on the weekly sell, we had quite a bit of volume. We're at that 0.23 retracement in the weekly. I think we got to be really careful. If we start to see 2 days of rise, we may have to get back in. It might be at around 118 versus 116 where we were originally at, but we're gonna have to really watch this closely. We had SPLD, was it? I always mix this now. No. It's the other bond was SPTL. SPTL, and that's treasuries as well. But instead of the 20-year, it's actually a more longer duration bonds. And this one, we saw the same thing. Broke the Twomey trend track line. We never really eclipsed it up here. We just fell flat. And we got both the first, third, and second, third hit on Friday. Will we return into this? Well, depending on how our second, third goes. We had an interim one as well. And that is doing the same thing. Let's look at our corporate bonds, VCIT. Same deal there. We definitely got the first third, the second third as well. And then the other corporate bond we have is SPLD. That's the one I was thinking about, SPLD. And we also have an intermediate midterm bond, and that's doing the same thing. SPLD. That's not quite it. That's not quite it. What is it? It is SPLB. Typo there. SPLB. Same thing. So I don't, this is all a reaction. Basically, now we're in reactive trading, but we preserve some of our profit because we get them down here. And, these are kind of bond ETFs where you can park a lot of money. You get a couple percent. You can stick it out for the year for dividend play, and, gives you enough room to get in and out. But this is kind of major fluctuations, right, that we just saw on Friday, all based on the fact that, the Fed's going to keep the gas on raising rates. If that's the case, eventually yields are going to rise. That's the theory. We have yet to see that. It abated. We had it all pre, the market crash, but once we got into the 20% correction territory, yields went flat. So I'm going to wait a couple of days, see where the inflection point goes. We may add or not, or we may just be totally out. That's it. Now, that was a lot of speed that we had several weeks there for that to happen. I really anticipated this would go well into the end of August based on all the fundamentals out there, and especially on what the companies were doing on, even though we had, a lot of earning guidance was, lowered, and companies weren't really that robust in earnings like they have been in other quarters. It wasn't devastating. So TBT, which is 200x shorting of the 20-year treasury. It is above, this is very interesting, it's above the 14, it's above the 9, but we have a negative, we're down, the stochastic's just starting to turn, but it's in the low, 25s, 20. The MACD is still negative and negative territory. We haven't got our buy-in signal. It crossed above our Twomey trend track line. We go to our 120 chart. We got the buy, with the crossover positive. So I went in Thursday and bought some small position on my mouse hunt. Since you can use TBF as well, that's 1 times, not, this is an accelerated. TBF is the 1-to-1, so there's less, volatility, less swing, but the same story there in the 120 minute. So you can take a mouse hunt position on that, but I'm not sure. This may just be a bounce here, but I'm in it, and if I've got a tight stop, and I'm not gonna mess around. So those are some interesting items. So what is that all telling us? Well, we've got some money being pumped into the economy. It's affecting things like, our solar stocks and alike. SMH, I don't typically play this one. This is the Van Neck Semiconductor ETF. It's rising. It hits the 200. I took a small position Friday on a pullback. It's definitely, the buy signal is back, way back here when, everyone else, this is why the market is so strong. Everybody got the buy signal basically within a couple of days. All the indices and the semiconductor. Now with the semiconductor bill pretty much ready to be signed, if not already, it is going to, if it eclipses 200, this should run up. So, on a pullback, take a small position. It's worth taking a ride. That's that. Other than that, you just got to be careful. If you do pick some stocks, use the Twomey investment principles and process. We're still in an ultimate downtrend, but it's improving. And our advanced decline as of Friday, very nice. We talked about this. The relative strength index, though, 69.3. Every time we get up to a high relative strength index up in the mid to high 60s, we've had a pullback. We have to see where this is going. We had a little bit of a pullback Friday, but the MACD is pretty strong, and we've got well above our 50 EMA, and there's a good chance it's going to run up into the 200 EMA. But it's still in an ultimate downtrend. But it's definitely improving, and it's been improving for a good period of time. If we get over this sideways move, if we can handle this RSI being high, then we should get a little bit more growth of our stock positions and maybe have some other entries or add to them the month of August. So we are in good shape until we get that negative inflection point. We may have to go back and add to some of our bonds, may have to add to XLK. So the Twomey stock market report, we're getting closer to launching the web version model, which will be a lot easier for folks. They'll be able to subscribe, get an email alert. They'll go in and view the information at will. Will really minimize a lot of this that we're running into. Let's see, any increase on a particular stock, let me know. We could definitely discuss those. Be happy to hear from you. And happy trading in the up and coming week. This is the weekend quarterback report. Happy trading and good luck. Thank you.